Carson. I was on Wall Street, both a sell side and buy side for almost 40 years, doing economic consultant work. I've studied business cycles for several decades. And what I've learned over studying business cycles, there are both common features and unique features in each cycle. What's so interesting about the environment that we're operating in today is that some of the common features are very unique. For example, fiscal policy. I mean, as you know, Congress has put in place more than $5 trillion of federal stimulus in the last 12 months. That equates to about 25% of GDP. When I started my career many years ago, the biggest stimulus package I've ever came across was what Ronald Reagan did back in the early 80s for tax cuts and defense increases. And that amounted to about 3% of GDP. So you can see we're way off the charts in terms of what the Congress has provided to the economy. I have to tell you, a lot of it's unspent. And a lot of it has no sensitivity to interest rates because a lot of money was directed to state and local governments. You read in the press what California may be doing with their huge surpluses, and also New York and other states. But keep in mind here, in the last two recessions, the state and local sector provided a headwind to the economy. This time it's going to provide a tailwind because it has a lot of money to spend, and that's coming. The other unique feature today, which is usually a common feature, is the monetary policy stance, as many talked about. I mean, not only did the Fed cut interest rates quickly when there was a sign of distress last year, which they had to do, but they bought $4 trillion in securities, and they say they're going to keep on buying. That's unprecedented in the sense that they're buying securities in sectors that are booming. I mean, median house prices are up 20-some%, record levels, and the Fed continues to support that market, which is unprecedented. And one unique feature of this cycle, I will tell you, is the liquidity and wealth. If you just go from the start of 2020 to the first quarter of this year, the market valuation of equities has increased by $12.5 trillion. Now, in the last two recessions, when you had them in both 2001 and 2008, 2009, there was $8 to $9 trillion lost in equity valuations. So you start this cycle with enormous amount of wealth and liquidity, which is really unique, okay? Because usually you build up liquidity and you try to reliquify the system from a recession. We start this cycle with the domestic equity valuation to GDP at 2.4 times. The prior peak was 1.9 at the peak of the tech bubble. So to me, the market is way ahead of the economy. And then you have to look at all the risks that are out there at the present time. I heard one of the initial panel was talking about inflation. In my opinion, the Fed is way off the mark on this inflation cycle. It's not transitory, it's not temporary, and there are some effects, but the numbers speak for themselves. If you just start from the beginning of this year, consumer prices are running at a 5% annualized rate, and core inflation is 5.5%. Those are the biggest numbers in 3 decades, okay? This is the first cycle since the early 80s that we reversed a lower peak-to-peak increase in inflation. So what I mean is that in the 1980s, the peak core rate of inflation was 5. It was 2 it was 3 in the 1990s, and it was 2.5 or a little bit lower in the last 2 cycles. It's now already approaching 4%. That's a major reversal. And one thing people don't realize is that inflation cycles develop their own momentum and sustainability. Okay, I just put this little article up on LinkedIn if you want to read it. Remember what prices do, they generate revenue and income. Okay, so Mr. Powell has talked about how, you know, there's certain reopening features in the prices, numbers being reported that are not sustainable. For example, airline and hotel price increases. But those higher prices for airline tickets generate a lot of revenue. They force airline companies to bring back a lot of workers, which generates more income. And keep in mind, the one thing that I said a year ago, in March of 2020, the reason I thought we would have a sharp decline in GDP is that economic growth is a function of mobility. When commerce stops moving, growth collapses, as it did last year and as it did in 1980, okay, when we had credit controls. The reopening of the economy creates enormous mobility, and as people move around, they spend a lot of money, okay? So the other thing to keep in mind about these price cycles is that once they start, they don't end without some nudging or restraint from monetary policy, okay? The last cyclical increase in inflation that we experienced was in 1994, when we have some similar features. If you go back to 1994, a lot of the headwinds that were keeping growth suppressed started to fade away. There was the household deleveraging, the defense cutbacks, the corporate restructurings, and easy money provided a cushion and started to push up growth pretty quickly. Greenspan, or I would say the old generation of policymakers, saw this developing, and they tried to curtail the cyclical uptick of inflation. They raised rates by 300 basis points over 12 months to contain it. We generated a soft landing. This generation of policymakers is doing the exact opposite. They're encouraging the cyclical inflation uptick by keeping rates low. It makes no sense to me that operate the same policy we have today when housing is booming, growth is fast, jobs are in short supply. Job availability is the highest on record, but there's a shortage of workers. So wage pressures are kicking in as well. So this cycle has a lot of common features, unique features. You haven't started a cycle in the last 3 decades with this type of inflation pressures this early. You haven't started a cycle with this amount of job vacancies. 9.3 million job vacancies right now. The last 2 cycles we started with 2 and 3 million job vacancies. So workers are in a better bargaining place. And the other thing I would point out to you, as growth picks up, the one thing I think investors are missing is the profit side of the equation. Now, there are 2 types of profits being reported in the aggregate for US companies. There are the financial reports that companies report to the shareholders and the press that come out when they report their earnings. And then there's economic profits, which the government reports in the GDP report. Financial profits allow companies to include capital gains, income, but also allow them not to account for all their expenses. Economic profits take out capital gains, but include all the expenses. And in the first quarter of this year, you saw something that never ever happened before. Financial profits, S&P profits, went up 50% over the fourth quarter. Economic profits had no gain. Why was that? Profit margins shrank. What companies are doing at the present time are trying to raise prices to protect margins, and they can't. So this develops a cycle on its own. So from my standpoint, yes, everything looks good. When you got easy money, a lot of things look good because there's little hurdle opportunity cost for not taking risks. But there's an eventuality here that has to show up. Workers are going to get more income, and as they get more income through wage increases and job increases, they're going to spend money. As they spend money, there's going to be put more upward pressure on price. To me, what's going on today is the dialogue that these things are transitory and temporary are going to change in the next 6 months if they're more percent and large and large and large and then large and then a lot of momentum in the economy, a lot of liquidity, and a lot of wealth, and that's going to continue through the second half of this year. But going into 2022, there is a big risk of a rate increase much bigger than people think. And remember back in 2018, when Powell and company tried to raise rates just to get back to real interest rates to zero, the market fell 25%. You start this cycle with real interest rates negative 300 or 400 basis points at least. So you got a lot of upward movement in interest rates that has to take place to break this cycle. And I have never seen an inflation cycle, whether it's a general inflation cycle by the CPI, an asset cycle with techs in the 2000 or a housing cycle that ended well. So I'm not going to pound the table today, it's going to end tomorrow, but something has to break this. And usually it's broken by monetary policy. I don't know how long do you want me to go on and talk about the other thing, but the other thing I would mention to you is that, and this is really important, the inflation that's being reported today is not the same as reported in the 90s or the 70s. We take out housing out of the calculation. Housing is running at a 20% annualized rate, and in the CPI, the housing shelter component is 2%. Now, you can say reported inflation, whatever the government says it is, but just because we exclude certain prices doesn't mean they don't exist or they don't matter, okay? And so there's a lot of price increases that are occurring that are outside of reported inflation measures. And I would just point out to you that this housing cycle is bigger than we had in the 2000s. I mean, we have a 20% increase in 1 year, that back in the housing bubble, that was as much as we got in 2 years. And if you look at the producer price side of the equation, commodity inflation or price increases for industrial materials in the last 12 months are up 17%. In 1994, we had a cyclical increase. The peak increase in that was 5%. So this is more than 3 times bigger. So there's a lot of momentum on the price side that's going to show up in revenues, inventory profits, and so forth down the road that I think is going to surprise people. But inflation cycles create a lot of income and revenue on the way up, and they create a lot of distress on the way down. So let me end there, see if there's any questions.
I have some questions. So, given your thoughts on inflation, what do you think are safe harbors right now for, the investor class? And if you were on alternative investments, where would you see people in alternatives? Venture capital, real estate. A lot of people have said that venture capital probably isn't a good, or tech isn't a great investment in an inflationary environment. Any thoughts?
Well, that's true. I mean, usually, you got to go into real assets. I mean, the real asset community should start gathering some funds here because, you're bidding up the value of all these assets. You got to build a lot of new ones. But again, the inflation signals are not being transmitted to the financial market because the Fed is blocking it. When you own 30% of the treasury market, it's hard to get interest rates to go up. So the Fed, and I always take the inflation signal through the 10-year treasury as an important signal because it tells you that the economy and the markets are working together. The one thing that I will say to you that it troubles me is this. We have put so much money into the system from the federal government as well as the monetary. We don't have the policy defenses if things go bad. Okay, remember when the tech bubble burst and the housing market burst, funds rate were at 5-6%. Funds rate is 0 tells you you have little room to provide a cushion to the economy. So again, this cycle is going to go on because central banks around the world are pumping it up. But you never started a cycle with peak market valuations. So to me, equities are way overvalued relative to profits and economic activity. So I would take something off the table there. And again, you can't really find a home in fixed income. There's no return. So you got to go into real assets. Housing, to me, it's more of a local story than a national story. There's definitely markets there that are overheated, and you got to be careful. I'm sure that some of this will spill over to the rental market and lift those over time. But it's really a unique cycle. And again, I don't have all the answers to that right now.
Joe, just as a side point, we had Paul Stevens speak from Robertson Stevens, and he's a guy out of Tiburon in California. It was probably in 2010, and his comment was that the Fed was out of control and that they were just printing money, and so therefore he was buying real assets. So his idea was to try to corner the walnut farm market in California. And then he said, I've also invested in something called a Bitcoin mining company for his two kids, Bart and Brad, who went to Princeton. And so if anybody knows, Bart and Brad Stevens have made a fortune on Bitcoin because they were mining it at $10. So it's always interesting. There's always opportunities there in the, alternative assets, real asset, positions. And so, we're always looking for tidbits of advice on where to go next. So if you're saying real assets, so my thought was that it seemed like farmland was a little bit overpriced to me, or it goes through these cycles of being overpriced. So to me, it's kind of a riddle of where to buy, and yet even if you look at real estate, real assets, there's a lot of guys who are distressed right now as well. So
yeah,
it seems like there's like an asset, like if.
Yeah, you're right. The first off, I'm really puzzled by cryptocurrency in the sense I see. If I told you not to invest in it, I would look like a fool, like I am. But for me, for something like this to really gain traction and be important, people eventually have to get paid to use it. They have to have their income be in there to make it transactionable. And I don't see that happening anytime soon. And I think eventually when the regulatory changes take place in this market, you're going to see a reappraisal of what it means. But again, I just think easy money creates all these different financial toys, which I call them financial toys, to gain traction. And financial toys without any underlying value crash hard. Sure.
And I know we're going to have a real estate panel later today, and they're going to discuss housing. So do you see any triggers there's all these multifamily owners who they haven't been paying their mortgages because nobody's been paying their rent. Do you see any triggers in that marketplace that could happen? I guess California just announced they're going to bail out multifamily owners because people haven't been paying their rent. So any more thoughts on that?
Well, yeah, I think once a lot of people get back to work, they're going to start making many of those payments that they're in arrears on. But I think a lot of these states, New York, Texas, California, and Florida, that get this huge sums of money from the federal government, are going to use some of that money to help homeowners pay off some of their outstanding debts. That's an interesting thing because people don't realize in the past, when you had a recession, you usually had a lot of strains on liquidity, household liquidity and corporate profits, right? Now you have enormous amount of liquidity and government's going to bail you out. You can't keep bailing everyone out without some type of price hitting the economy. So let's say we get 6% growth this year, which is very likely, and maybe 4% growth next year. How can the Fed keep zero interest rates? It's not just the policy of promoting asset purchases and low interest rates. It's the promise that's out there of no rate increases to 2023. That just opens up Pandora's box, and you take all kind of risks. So that's what's happening out there. The Fed has made the markets more of a casino.